I'm Shay Boloor, and this is Earnings Edge. So we're going to talk about Google, who just delivered one of the strongest operating cores of the current AI cycle, yet the stock is still down after hours, which might sound confusing at first because the actual business results were exceptional. Since revenue grew 24% to nearly $120 billion, Google Cloud is now growing at an 82% clip. Search is still very healthy at 17%. Even YouTube advertising is growing at 13%. And Gemini is clearly gaining a ton of traction across not just the consumers, but large enterprises as well. But the reason the stock is falling isn't at all because the demand is weakening, clearly from what the numbers that it's reported. It's because quite the opposite. Demand is growing so quickly that Google must spend even more now to keep up with it. And management raised its CapEx guidance for 2026 and said it will temporarily rent more expensive infrastructure from outside providers because essentially Google cannot build its own capacity fast enough. So now the debate after this quarter is no longer whether Google's AI strategy is working, because it clearly is, but whether the company can fund one of the largest infrastructure expansions in corporate history while still delivering strong margin and attractive returns for shareholders. So let's get into more specifics of the earnings report. The most important number in the entire report was obviously Google Cloud. This is the one business segments that's actually going to move the needle for the stock. Like I mentioned, they grew 82%, which is a crazy number at the scale because this is now a $25 billion business. And it beat expectations by nearly $2.5 billion. So it beat expectations by at least 10%. So that was impressive because the bar was exceptionally high after Q1's beat. So even the most optimistic forecast heading to this print was still way lower than what the actual business produced. So more importantly, it wasn't just revenue growth. I mean, operating income also tripled to $8.8 billion while the operating margin expanded from 21% to now it's 36%. So now you have this business that's growing 82% top line with 36% operating margins. It's crazy. And it's huge. It's like, this is a huge moment for Google because AI infrastructure is extremely expensive. If you're like a Google, you're going to have to continue to purchase not just chips, but also memory and networking equipment. You have to continue building these massive data centers, secure electricity and cooling, and essentially install everything before customers can begin using the capacity. So for years, the biggest question surrounding this AI build out has been whether hyperscalers can create profitable businesses or simply spending enormous amounts of money to defend their existing positions. And clearly, after this report, Google is in the part of the AI economy that's highly profitable. I mean, those margins with that top line growth is exceptional. I think that Google Cloud actually produced more operating income this quarter than it generated in total revenue less than 3 years ago. That tells you how much this business has grown. And not just that, the margins have just expanded at a rapid pace. And also, cloud is becoming much more important to the overall company since it now represents more than 20% of the total revenue. And it's growing several times faster than search, YouTube, and the rest of the Google services. So I think over time, like this is going to be a lot more of a predictable business for Google regarding like the multiple of what you should be buying Google as a stock, because historically Google has been like an advertising company, but this quarter really strengthened the argument that this is a business that has two major profit engines: digital advertising and AI infrastructure. The next major number from this print was the backlog. I mean, it crossed $500 billion. Now Google Cloud's backlog is $514 billion, which represents um, revenue essentially that customers have already committed to under signed agreements, but that Google has not yet fully recognized. That's what that backlog number means. So essentially, Google expects to convert slightly more than half of that backlog into revenue over the next 2 years. Management has also said on the call that existing customers are now consuming more than 50% above their original commitments, while new customer acquisitions has more than doubled from last year. So that to me suggests that Google is essentially trying to fulfill demand that already exists and is growing way faster than expected. Obviously, the risk is that you can't assume that backlog is going to guarantee attractive returns because Google still needs to deliver the capacity on time. They have to manage their energy and equipment costs and avoid signing contracts that look attractive on revenue, but it's going to generate a lot weaker profits and poor margins. But I don't see that proof yet because cloud operating margins at 36%. So that shows that the infrastructure is already running right now, is being monetized extremely well. So I'm anticipating the backlog will convert as well to maybe not the same margins, but similar enough. Also, the Gemini adoption is moving well beyond the experimental stage since Gemini app now has reached around 950 million monthly users. Gemini models are now processing, I think it was around 22 billion API tokens every minute, which is insane because just last quarter it was 16 billion. So now that's a huge sequential jump in tokens per minute, which is everything in this like inference boom that we are experiencing right now. And also, management said that nearly 90% of the Fortune 100 companies are now using Gemini Enterprise, and more than 9 million developers are building with Google's models each month. So these are all really impressive figures, and I think it shows that Gemini is being used at real usage at scale, since now companies are beginning to put the AI into real production, which requires a lot of continuous access to computing power, security, storage, databases, networking, and software tools. Like, takes a lot for companies to specifically not just capitalize on AI, but use AI on a day-to-day basis. And that's exactly why Google's full stack strategy has become so valuable, because Google isn't just selling Gemini as a standalone chatbot like the OpenAI is. Like, we have to go use ChatGPT. Like, Gemini is truly this connectivity layer inside their ecosystem. Like, it's connected across Google Cloud, Workspace, Search, advertising, Android, Chrome, cybersecurity, and data analytics. So the same investment in Gemini can therefore create revenue across several different products, which is why Google really doesn't need Gemini to win all these model benchmarks that we're seeing all over FinTwit. Like, it truly just has to have a good enough product, because their cloud platform, as of right now, is supporting the NVIDIA GPUs, Google TPUs, Anthropic's Claude, open source models, and a wide range of development tools. So even if a customer chooses another company's model because it has a better benchmark score, has a better specific query that it handles better than what Gemini does, it doesn't matter, because Google will still make money by providing the infrastructure where the model is trained, deployed, secured, and operated. Let's also talk about me. I should say it's the legacy business. I mean, the search business. Like, it's still a big chunk of their business, but this was the segment that a lot of people 2 years ago said that AI was going to disrupt and this was going to turn Google into a dinosaur. But if you're listening onto the podcast, Future Equities podcast, you knew that we believe the complete opposite. And the signs are still there that the search business is much healthier than a lot of the original AI bear cases suggested, because it's growing 17% to more than $63 billion, despite the rapid growth that we're seeing right now across Claude, ChatGPT, Perplexity, and other AI first products. So I think that a lot of people believe that these platforms would quickly weaken Google's core business by replacing the traditional search queries, but that really hasn't happened so far. And also, not just the defensibility that Google's had on the search business, they're actually using AI to force a tailwind on that search business, because now management also talked about AI. The AI mode has surpassed 1 billion monthly users, while uh, a lot of like the AI mode and AI overviews are now generating additional search activity rather than just simply replacing existing searches. So I think the company also mentioned something about bringing down the cost of serving AI generated answers, even as it adds more advanced capabilities, which is huge, because the search debate really has two parts to it. The first question is obviously whether people will continue using Google in an AI world. And the current revenue and engagement that we've seen so far suggests that they absolutely will. The second question, though, was whether Google can make money from AI generated answers without destroying the economics of search. It was a really tricky balance to benefit from AI, but without eroding your legacy business. I do think that this quarter offered encouraging signs that serving costs are falling while advertising tools and monetizations are improving, which to me is a really great thing to see. I also think that it's really important to note that Google's already placing like clearly marked advertisements inside AI mode. And they're also using Gemini to understand longer, more detailed searches that were previously difficult to monetize. Obviously, advertisers are going to be using tools such as the AI Max and Performance Max, and they are already actually seeing better conversions results at similar returns on advertising spending, which is great, because that increasingly will resemble Google's transition from being a desktop to a mobile rather than a collapse of search. I also think that the interface is changing. So I think that you're seeing Google's ability to adapt the advertising model around this new AI world at a rapid pace, and that's great to see. Also, I mean, regarding that YouTube, that it was a solid quarter as well. I mean, it grew 13% to 11 billion and beat expectations. I do think it was really nice to see that the subscriptions continue to grow faster than the advertising through YouTube Premium, Music, and other paid products. So YouTube is obviously the least sexy of these business units that we're talking about for Google, but it does give Google that massive global platform where Gemini can improve recommendations, search, advertising, content creation, and commerce. So the strength now, like across search, YouTube, and cloud, is like really important. That they're all like humming at the same time, because Google isn't really funding the AI transition from a deteriorating core business. They're actually funding it from a place of offense. Like, they're doing it because they have the luxury to do so without having to need to do so. Especially when the Google services revenue is growing 15%. That the income as well is growing 20%, and that segment alone has maintained like operating margin above 40%. So like that means that Google's existing business continues producing enormous profits, even while the company invests aggressively in the next generation of AI infrastructure. Let's talk about why the stock is down. Listen, Google raised its CapEx number, and market doesn't like that. They never like hyperscalers raising CapEx numbers. 2026 CapEx outlook went to $200 billion from $185 billion. It's a $15 billion jump. So the company is now spending more on CapEx in a single quarter than it did all of 2022, which is crazy to see. But this is the new AI economy that like this is the build out that is providing exceptional returns at a rapid scale that I think it's worth it. I mean, management also indicated that spending will increase significantly again in 2027, meaning that this investment cycle isn't close to peaking. So the market is now therefore asking whether even exceptional cloud growth can justify a capital spending program of this size. I think it does, but that's probably one of the reasons why the stock's down. The second reason, in my opinion, is Google plans to use more third-party computing capacity during this third quarter because the internal supply cannot keep up with the demand. I think management talked about this as like this bridge while Google builds more of its own capacity. I do think that trade-off is obviously rented infrastructure costs more than the infrastructure Google owns, which will create some kind of near-term pressure on the cloud margins. But again, like we're talking 36% operating margins. This cloud business is going 82%. Like, what are we poking holes here? I mean, Google, yes, Google is effectively choosing to accept lower margins for several quarters rather than tell major customers to wait. But these are exceptional numbers that they're producing already on the Google cloud business. Like, sacrifice a couple of points on the bottom line. That's fine, in my opinion, because strategically, this makes sense to do so because losing a large enterprise or like these frontier AI labs during a period of limited capacity is going to allow that customer to build its long-term infrastructure around a competing cloud provider. And you don't want to do that for Google. So I think the market is just punching the stock a little because it wants proof that this temporary bridge doesn't become permanent, which leads to the third reason I think the stock's down: free cash flow. As crazy as it sounds, they had negative free cash flow this quarter. I mean, Google generated $39 billion of operating cash flow during the quarter, but they spent $45 billion of CapEx. So that obviously leads to a negative $6 billion. That's a huge change for a company historically known for producing enormous amounts of cash while repurchasing stock. Also, Google is funding several expensive priorities at the same time since the company has begun training Gemini 4, which the CEO has described as a much larger base model needed to compete at the next frontier of AI. Obviously, this is an expensive race that Google is part of. AI is a prisoner's dilemma with the companies competing in and have the deepest pockets, but listen, upside is there. All this money is going towards CapEx, the same infrastructure that can support several revenue streams, since a stronger Gemini model can improve search, advertising, workspace, cloud, like the list goes on. The downside is obviously that the frontier AI development is becoming a lot more expensive than a lot of people anticipated a year or two ago. And there's no guarantee that the company can maintain a permanent tech lead. Like we're at the fluid stage of AI. Nobody can predict what these companies will be like in 3 years because the rate of change has been exponential. But I do think this quarter was much stronger than the stock's after hours decline suggests. And I think that Google showed that the demand is real, cloud growth is accelerating, Gemini is reaching meaningful scale, and search remains healthy, and AI infrastructure can generate excellent operating margins. So I do think that Google's AI strategy is working operationally well, but the market is just continuing to debate the financing cost of scaling it. But that's nothing new. I do think that the market will look past whatever heartburn it has from that $15 billion increase in CapEx, a temporary free cash flow negative quarter, because Google controls one of the most complete AI platforms in the market. But this next phase that they're entering is they're gonna have to show that the cloud margins can recover after the temporary use of outside capacity, that the backlog can actually convert into profitable revenue, and that the free cash flow is going to rebound once the most aggressive stage of the infrastructure build out passes. But for now, I think I view the stock's weakness as a reaction to size and timing of the spending cycle rather than any signs of deterioration in their underlying business.